Good morning, everyone, and a very warm welcome to the STANLIB webinar series. As always, we're very grateful to have you join us and spend the next hour with us. Thank you. I'm Tracy Kutzer, and I head up the institutional distribution team at STANLIB. This morning, I'm joined by my colleagues in the STANLIB Balanced and Equity Investment team, Senior Portfolio Manager, Kobus Nell, Head of Equity Research, Andrew Cuffe, and of course, Fred Teeling-Smith, our esteemed equity analyst. Welcome, gentlemen. So I think after the turbulence of 2020, this year was always going to seem more benign. However, this certainly doesn't mean that managing portfolios and making asset allocation calls have been any easier. Portfolio managers have a myriad of risks and opportunities to assess and make sense of on a daily basis across global markets. I think for me, one of the hardest things for a portfolio manager in today's world must be trying to sift through the information overload, how to discern what is important and what is just noise, and what can move markets and what will markets shrug off. I think must be an impossible task on a daily basis. I mean, a really good example of this was probably how asset prices reacted in the first COVID wave versus how they seem to have just shrugged it off the second and the third wave. So with this backdrop in mind, we thought we would start today's session with insights from a balanced portfolio perspective. And Kirby will share with us STANLIB's balanced teams, what they're monitoring, what they're looking at, as I say, trying to unpack all this information, and most importantly, how this translates into their portfolio positioning. Following on from this, we'll hear from Andrew on the merits of investing in quality growth stocks in South Africa. This has to have been the topic of the last 6 to 9 months, value versus growth, quality, and how to make sense of these styles. And lastly, which I think in this section, you'll truly see the passion that our team has for what they do come to life in the session where we'll unpack some of our top stock picks in the portfolio. And this, again, I say, is really where the rubber hits the road. And then we've saved some time at the end for questions, and we'd really love to hear from you. So please post these on the chat, and we'll try and get through as many as possible. So once again, I hope you enjoy the next hour with us, and I hope we can provide some insights and importantly, explain what our team's thinking and how we are positioned going forward. Great, Kobus, I'll start with you then, and probably the best place to do that would be for you to help paint sort of a macro picture, the big themes that you and the team are watching, and really what this means for you and what you're keeping an eye on.
Yeah, thank you very much, Tracy, and welcome and hello to all the people that tuned in this morning. It's really a great privilege to have you on board. Yeah, I guess to start off maybe on some of the the sort of the burning points from a macroeconomic perspective. It's really been US inflation. And this has sort of taken center stage, over the last couple of months, really creating a lot of anxiety. Sort of in the beginning of the year, as we see bond yields actually spiking up quite aggressively. And the key reason for this anxiety around this potential US inflation overshoot is really the level of stimulus that the US government has introduced in the system and specifically to the consumer. And this chart basically reflects the gap which are currently in place in the US between the revenue that they get from various sources versus the expenditure that they are incurring effectively into the economy via the stimulus policies. This fiscal deficit is extremely wide. And the reason why a lot of the inflation anxiety is coming in is that the market's really saying, when you put this amount of money in the hands of a consumer, with stock levels that is actually relatively low at the moment, that you're going to have quite an aggressive inflation snap, an up snap that will scare the markets. And why will it scare the markets potentially? Because the market's also worried that the Federal Reserve in the US at some point will be forced to raise interest rates if inflation are showing signs that it could be out of control. And that obviously is is not great for long duration assets like equities. Higher interest rates is generally seen as an impairment to valuations. And, of late, I think the equity or risk asset valuations, specifically equity valuations, has enjoyed this world of very low interest rates and almost this extremely accommodative stance. And secondly, that's also very important, is obviously, the growth recovery, the economic growth recovery on a global basis. And on this side, in this slide, what it basically shows you is the drawdown that we've seen during the pandemic, and then obviously the bounce back that is now expected into the cyclical and stimulus induced recovery. One got to add, and the real important factor here is, how will the economic growth really look like beyond this cyclical recovery? When some of the stimulus measures gets detracted and the world moves more to a normalized environment. And that is really important because it really speaks to employment, and it speaks to the consumer and longer term consumption levels that in the end of the day speaks to earnings levels. And not just the forward earnings level, but also the growth in that earnings level that then can be expected from that point onwards. So this is really, really critical, and it's a tough question at the moment to see how will the more normalized growth environment look like beyond this cyclical recovery that we're seeing. And there's also quite a bit of uncertainty, I think, of where it will settle. Then closer to home, if you bring it into South Africa context, it's no secret that our GDP has been on a path of decay probably for the last 10 years, be it as it may. And then we've had this big, COVID-induced snap down in our GDP growth last year. And then we are looking forward to a recovery. But important to note that current expectations are that it will probably take us about 3 to 4 years to repair the damage in our economic base that was effectively done by this pandemic. And this is really important because, again, it speaks to many other factors, which includes inflation and interest rates in South Africa. Now, from an inflation perspective in South Africa, the view is really there that it remains very much within that band. Obviously, we've had a low of just above 2% in last year, and then a bit of a recovery into that. And the outlook from our chief economist, Kevin Lings, is that inflation numbers will firm up, but certainly remains within this band and well under control. And this is extremely important when you look at asset class like the South African bonds and where one can expect interest rates potentially to go to. And also for us, that's of great interest, which I'll touch a little bit more later on, is effectively the spread between your shorter dated or duration bonds and your longer dated or duration bonds, effectively the yield curve and the steepness of the yield curve from that front. So I hope that gave you a little bit of an insight into the macroeconomic environment and what is really important for us at the moment, and what we really are paying a lot of attention to. Then the second point that I want to move over is equities, and I guess in the equity market, I think to take a cue from history was really that earnings growth has been the most important and the strongest driver of shareholders' returns. Historically, dividend returns has also contributed a little bit, but ratings over time, and that's the so-called PE or price to earnings rating that is applied to the forward earnings or the current earnings, depends on how you look at it, has really been an insignificant factor of shareholders' return in the South African market over the longer term. And when you look at the current recovery and the current returns, that is effectively the black line on this chart, that you would see the sharp spike up that we've enjoyed in our equity market has mainly been driven by a re-rating, and that's effectively your blue bars in this chart. So that is really that investors paid more and more for a level of earnings. And that is really in light of a better earnings growth outlook that obviously the market is starting to price in and are looking forward into. The last point to note maybe on this chart is that the trend up that we've seen this time around has got a lot of similarities to the profile we've seen back in 2008 in the global financial crisis, where we've also seen a very aggressive re-rating in the market before the earnings, and that is the red color in the chart, has really started to improve. And that was a key driver of earnings a key driver of shareholders' return and the recovery in the shareholders' return. So earnings growth is very important. It's extremely important, as I explained, the most important factor in shareholders' return from an equity investor perspective. And if you look at a forward earnings and the forward earnings expectations on our side, has really been one that has been extremely robust throughout the COVID pandemic. You can see there, when we went through the eye of the COVID pandemic last year, probably from February to June, the forward earnings expectations probably declined of about 4%. And then subsequent to that, you've seen a rapid increase in the forward-looking earnings of our market. And that has mainly been driven by the resources sector, to name one. I mean, that's close to about 40% of our earnings base at the moment, to give you maybe an idea of the level of concentration in that. And the second one is really our communications sector, which contributes another 20% into that earnings basis. And that includes the likes of NASPERS and Process, which Fred will talk a little bit more about later on. But those two ones are almost reaching up to 2/3 of our earnings base in our market. So it is a concentrated earnings base and concentrated that two key sectors are really driving the bulk of that earnings growth. But it's also been an amazing story how resilient that profile has been throughout this pandemic, and what an important driver that was for equity returns.
So interesting. Thanks, Cuffe. I guess that brings us next onto South African bonds. And for me, this has definitely been an asset class. It's a bit of an anomaly. I mean, given our dire fiscal situation, those bonds have really held up well. And I know, I mean, as a team, that you still constructive SA bonds. Maybe you can chat us through how and why you have that view.
Yeah, Tracy, thanks a lot for that. It has been an interesting ride, and actually quite a bit of volatility, similar to the domestic equity market, in the beginning of first quarter of last year, as the COVID pandemic washed through the system. But yeah, you're 100% right. The impact of the pandemic has really done damage to South Africa's fiscal position, and effectively to its debt measures, debt to GDP, etc. And a key reason for that has been that the demand on the fiscus from expenditure perspective has been so much greater. That's the one point. And then secondly, also from a revenue perspective, given the lockdown in the broader economy and the limitation put on the economy, the revenue that was generally generated out of economic growth for the fiscus was impaired. So both those two areas has certainly done a lot of damage to the fiscal position we are now. Interestingly, and very interestingly now, where we stand today, is that we're actually looking forward to a projected income or a revenue outcome that will beat the initial budget estimate, and probably for the first time in 6 years that will play out. And some of the key reasons why that has come through has been that the growth in South Africa has been marked up more, so that has been improving. We've seen the South African Revenue Service really been much more effective in terms of their revenue collection. And then lastly, but certainly one of the most important drivers was the very high commodity prices and the metal prices in particular that the fiscus enjoyed through corporate taxes and royalties. And a combination of that has really driven up the so-called revenue line, or the expectation of the revenue line for South Africa. Coupled with that, we've seen that expenditure has actually come in below expectations into the recent budget. And although the wage negotiation is still looming, I think there's a lot of potential here that one can see a more disciplined approach actually becoming a reality at some point from expenditure perspective. And both those really speak favorably to government finances and potentially additional bond issuances. Maybe the last point on this is also to note that the cash position of South Africa as around 340 billion rand has been the highest on record. And that also maybe speaks to a lower issuances or projected issuances of bonds. And I think those factors, coupled with the positive developments, and I know at many times it's been very frustrating, but the positive delta almost that one has seen from a political and economic perspective in South Africa is really starting, in our view, to gain more pace and really showing some signs that it's moving in the right direction. And for us, from when you throw all of that in, the actual equity or the residual equity risk premium, and that includes your sovereign risk spread or default risk spread, and other related spreads that's not based on your base inflation rate, as per this chart of the US bond yield, and then the green portion, which is effectively your inflation differential between South Africa and the US. Other factors that explains that it's basically your red or your pink block here. That is really speaking towards that residual risk component. And our view in very simple terms is that is just too wide. And really then it brings this asset class into attractive risk reward metrics from that perspective. And this chart effectively speaks exactly to that point when one look over time at the spread between the so-called shorter duration or risk-free assets, or the so-called money market instruments as an asset class, the yield that you can actually achieve out of that relative to the yield that you can achieve out of your risk assets. And those includes then your South African bonds, longer duration South African bonds, and obviously your equity earnings yield as well. And that has been just too wide and extremely wide, and really presented the opportunity where we've really positioned the portfolio. And maybe the last slide I'll close off on this is that we've really moved the positioning much more towards this risk asset budget, really away from your shorter duration, as you can see in the chart, which is the purple line, the so-called money market or short duration income product allocation, towards your equity and your South African bonds. And those are really being the asset classes that we have been increasing over the last couple of years, and that sort of occupies a relatively high percentage in our portfolio. And it's simply speaking to our philosophy, where we are very cognizant of taking the right amount of risk for the right level of reward at the right time in the cycle. And as I explained, really our conviction really lies within trading a little bit up the risk curve, where we are given the yield so-called pickup or yield premium that you actually enjoyed in those higher risk asset classes.
Great. Thanks, Kobus. I actually don't want you to stop, because I could listen to positive South African stories all day. So, yeah. But good to see how it all comes together in your portfolio. Really insightful. Thanks, Kobus. So as I said earlier, I think one of the big subjects of the last few months has to be equity styles. So value versus growth, and is value here to stay? What does it mean for quality growth investors? So we thought a good place to go next would be to hear from Andrew, as I said, our head of equity research. on why the team still holds a high conviction that quality growth is a credible investment style in the South African market. So thanks, Andrew, if you can take us through that.
Thanks, Trace. Good day, ladies and gentlemen. I'm going to talk quickly and run through this quickly for a couple of reasons. I mean, one is that I just want to provide a framework, really a context for the discussion on stocks that come afterwards. And I think and the second reason is that I think it's important rather to focus on those stock stories rather than on the style. But the style issue is interesting, and I want to make 4 points about it. I mean, one is that we unashamedly a quality growth style within the equity component of the balanced fund, SA equity component. We follow a quality growth style. The second point is that it's a relative quality growth, very important. Third, this style we maintain is credible in the context of South Africa, and it's a style that we believe, while it has worked through time, we believe it will continue to work. That's the third point. Fourth, we want to make sure that our portfolio represents the style, and I want to show you that it actually does. So with that, let's jump in. So the first point, quality growth. I mean, and then we'll talk afterwards about the relevance of quality growth. What this is meant to do portrays is a quick graphic of what we do and a little bit about how we do it. But essentially, our whole process is shrouded in quality growth, and valuation can't be ignored. It's part of the process. But what our process involves is essentially it relies on deep fundamental analysis. That's the core of it. I think one of the unique things we do is we combine it with a fintech solution where we work alongside our index team. And we're able to, through this process, we're able to, using primarily 22 metrics, we're able to rank all our stocks. But our whole universe can be ranked in terms of the characteristics that we believe are important, quality growth characteristics that we believe are important. So at any time we can say, within each sector, we can say that's the best, that's not so good, and so on. So we use a fintech solution to help us do that. We use a fintech solution to help us test our portfolio construction. So it's this combination of fundamental research and screening, very, very sort of deep screening. The second point that I said is relative quality growth. This is quite part of the slide is quite ugly, but anyway, people say, well, quality growth doesn't have any, in South Africa. You can talk about quality growth in South Africa, and the important point I think for us is that it's not. There's no absolute level of quality growth that we require. What we're doing is we're looking at relative quality growth. So you may argue that the South African market looks like the bunch of the apples on the left, or you may argue that South Africa looks like the apples on the right, and we're probably indifferent to that. What we're looking for is we're looking within the best of the apples. We're looking for the best of those. So that's our job. We find the best among those. If we're looking along the right, we're looking for the best of those. That's what we're trying to do. So it's relative quality growth that matters. And I think the other point in this is that it's the combination of those characteristics. It's not, does it have enough quality? It's does it have enough of the quality growth valuation characteristics that we want? And is this a credible strategy in the context of SA? So that's the third point. And this is again work done by our index team. It happens to be those 22 metrics that I mentioned, and it's probably a little bit more conservative than we would construct a portfolio, in the sense that this has been back tested in a way that's sector neutral, so super sector neutral. So even doing that, and by selecting on the basis of stocks with a high level of these characteristics, if one had been disciplined in that approach, there's evidence that it works through time in the South African context and works very well. Does it work always? I guess that's the question. And now this is something we're faced with now. Where we are is, in a sense, exactly where we would expect to be. This, again, work done by our index teams, showing this is a macro indicator showing the SA economy through different stages: recovery, contraction, expansion, slowdown. And what the evidence suggests is that there are periods during recovery when we expect deep value to outperform. They're short, they're sharp, the magnitude of them is large. Deep value has its day. But in between, there's long periods when other styles we would include ours in these, show much more consistent returns. And that's just the way it is, and that's kind of what we've seen since late last year. Is there's been a short, sharp value rally. This is value versus growth, and that's entirely in line with expectations. What we believe is that this is no different to history. We see the short, sharp rally, then we move into potentially some expansion, a slowdown, contraction, and during those periods, we would hope our style comes to the fore. The fourth point I made was, do we look like we should look? And this slide is, so this is fact set data that examines various variables put into buckets: quality, growth, value, momentum, size. And what the circles show, although the yellow is growth, the gray is quality, the maroon is value. So what it shows is we over-indexed on quality and growth. So that's kind of that's what's on the tin, like we quality growth. That's what our portfolios look like, we quality growth. So we're very comfortable with that, and that's what we'd expect to look like through time. And we'd expect to be under-indexed on value, deep value metrics. With that, I think I'm going to stop there on the style. In this shows, I've just highlighted our top 5 holdings, and the reason is that we've had a high conviction on well, obviously all our positions we have conviction on, but I think we've had differentiated stories, particularly on Naspers, MTN, and the PGMs, and I think it's important to highlight that, and through that you can get perhaps a more flavor of kind of how we go about our business. So with that, I'm going to hand over to Fred and maybe take you through some of the Naspers process views.
Fred struggling to find his unmute button.
I'm not struggling to find my unmute button. I'm struggling to find my camera. There it is. There we go. Good morning, everyone. Sorry.
No problem.
I couldn't find my start the video button. Thanks, everyone, for joining us. I think I've probably got the best job in our research team, covering Naspers process for the last number of years. It's probably the most exciting company on our stock exchange, especially when you consider the context of our investment views in terms of growth quality. This firmly ticks the box of growth. You'll see within the stable, you've got food delivery, the classifieds, payments, and EdTech. Core businesses within process are just starting to grow at a growth rate that is going to see them growing at a faster rate than Tencent. And all that combined, we see the growth rate in Naspers and process earnings to be above 35% over the course of the next few years. But having said that, it's important to understand what this company looks like. It is still all about Tencent, and this real graph really shows you that over the last few years, the blue line is the Naspers reported and process reported earnings profile. The red is the contribution from Tencent to the Naspers group, and you'll see since March 2018, even through to over the next couple of years, the Tencent contribution to Naspers earnings is greater than 100%. And that's as a result of Naspers investing in the rump business. And that rump is made up of the classifieds, food delivery, payments, EdTech, e-tail, and then there's a ventures bucket, which is future opportunities that Naspers sees. And it's important to realize that as the company focuses on trying to unlock this discount, the massive discount that we see between the Tencent value in Naspers and the actual market cap, one of the reasons, in my mind, for that discount to have widened over the years has been because you've had these losses from the rump assets that have been coming through. And for a couple of years now, we've been saying that until such time as the rump assets can start growing at a faster rate than the earnings from Tencent, the discount continues to widen. And that's where we've been over the course of the last few years. But we're just getting to a point where we're starting to see the J curve coming through in the rump assets. But having said that, I guess the reason why we, I guess there are 4 reasons why we don't want to be underweight Naspers at the moment. And we're conscious of the fact that it is such a big weight in the Swix index. It's ticking back up to 25% now, I think close to 23%. And we have a high weight, close to 23% in the equity, SA equity chunk of this portfolio. And the reason why we are comfortable is firstly Tencent. Tencent is a higher quality growth company, and we're still getting it today at an attractive valuation. Over the years, Tencent has been ramping up its investments, and today about 30% of its existing market capitalization is the value of its underlying investments. It's probably one of the biggest global tech investment firms through its massive portfolio. And what we're seeing in the market cap is that although they've invested in all these underlying companies, we haven't seen the earnings starting to come through from those underlying companies. So if we have a look at the forward valuation of Tencent, stripping out that big pool of investments, you'll see it that is actually at valuation levels that are the lowest that it has been for a number of years. But moving on to Tencent, I guess it's important to talk about Tencent because it is the most important component of the Naspers story. And without us ticking off the box that Tencent is a company that we like, we can't hold Naspers. So the majority of my time is really spent understanding Tencent as a company and where it is growing. And the next slide, I guess, gives you a snapshot of how this company has evolved over the years. I mean, if we wind back to 2000, 2001, when Naspers bought into Tencent, a lot of people actually don't remember that when Naspers bought into Tencent, it was an unlisted company. They actually bought 50% at the time. And when Tencent listed on the stock exchange, when they raised money, Naspers' shareholding was diluted to the mid-30s. And they have sold a couple of chunks over the last 6 years, the last 3 years. One chunk being 3 years ago. More recently, they've sold another small percentage. So their residual holding in Tencent now is 30%. But this company, Tencent, when Naspers bought into it, it was really an instant messaging platform. And it was generating revenue from selling emojis on mobile devices. It was using the mobile networks in China Mobile, to get the revenue from its users. And today, they don't earn any revenue from that revenue stream. So it's actually quite incredible to look at this company and say that today, what it was 20 years ago does not exist. And I guess this evolution of the mix of revenue from 2010 through to 2020 gives you some snapshot of how this company has evolved. And over this period, it's had a 10-year compound annual growth rate of 38%. That's growing revenue at close to 40% every single year for the last 10 years. Now, as an analyst, when you look at that, it's almost impossible for analysts to forecast this sort of growth rate in the company. So I guess the question you ask is, how do we do it? And how are we comfortable that this company continues to grow its revenue at a fast rate? Now, the answer is, there's no ways that where we are at the moment, that the growth rate is going to be anywhere near 40%. But what we do see is the growth rate in revenue for Tencent being sustainably above 20% for the medium term. And why is that? I guess it's trying to understand how this company operates. And I guess when I look at our interactions with management teams over the years, the one interaction that is probably the most valuable is our interaction with the Tencent management team. And the individual that we do see is James Mitchell. He's a ex-Goldman Sachs investment banker that was joined Tencent many years ago when it first started. And asking him, I recall a meeting we had with him probably 4 or 5 years ago, trying to understand the business. And at that point, it was around about 2015, online gaming was over 50% of the revenue stream. You had the social networks where they were starting to sell users information around literature, music, and then advertising was becoming a larger chunk. When I asked him, I said, James, as an analyst, it's quite difficult to forecast where this company is going. Tell me, what does Tencent look like in 10 years' time? And he sort of paused for a moment. And it's the first time I've had this answer from a management team. He said, I can't tell you what this company looks like in 10 years' time. So I said, well, why do you say that? Please unpack that a little bit for me. So he says, well, what we're trying to do in China is we're trying to focus on the internet. And our objective is to make sure that we grow our share of the internet economy in China. And we've all seen how that internet economy has evolved in China. And Tencent has evolved with it. So his answer was quite insightful. In fact, he didn't stop there. He said that not only do we want to grow our internet revenue in China, we want to grow our share of the internet economy in China. So wherever we are making money from the internet in China today, we want to make sure we evolve with the internet as it evolves in the country, and we make more money. We are taking more share of the internet than we are today. And I guess if you look at where they are in 2020, the businesses that they've evolved into, fintech and business services, cloud revenue, that's what they're currently doing. And the businesses that they are currently working on today, being healthcare, more enterprise solutions, education, those are future revenue streams that we see evolving. But having said that, with regard to the internet economies, he took a step back and he said, what I can tell you is I don't know what this company looks like in 10 years' time, but we will make sure that I know that we will still be making a lot of money out of gaming. And that's exactly where this company is today. So gaming remains the core for Tencent today. And as we look at it, we see this evolution of the company and the evolving revenue base supporting this growth investment case for Tencent. And gaming is another quite good example. Whereas 10 years ago, the majority of their revenue from gaming was from PCs. As this device has evolved, the smartphone, we've all got one of them, an Apple smartphone. We've seen how the technology has evolved on a mobile device. So now Tencent has the ability to move their PC games that users loved so much and move it onto a mobile device. And this mobile device gives users the ability to replicate the nature of the games that they were playing on PCs onto now a mobile device. And as a result, you get into a point where Tencent has had the ability to grow the number of their users on paying platforms, not only grow the number of people that are paying for things, but also to grow the value they are getting per user. So there's a strange thing in this company is that forecasting user growth and average revenue per user, often what happens is user growth, paying users forecasts increase. But as an analyst, you don't often forecast the absolute growth in the revenue per user. And that's where Tencent has been so good. They've been getting more of their 1 billion users to pay for more things and grow this revenue stream. So you're getting this growing paying user base, and you're getting this growing revenue base per user. So Tencent is the most important component of the NASPAS and process investment story. Now moving on, The second reason why we don't want to be underweight is coming back to what I said a little bit earlier on, is the rump assets are now starting to grow at a faster rate than 10 cent. And just touching on one component, food delivery has been the one sector within NASPAS that has benefited majorly from COVID. And their food businesses in Brazil through iFood, in India through Swiggy, and then their investment in European food businesses through Delivery Hero has benefited massively over the period of the last year. And I could talk another hour on that, but I'm not going to. I'm moving on to the third component of why we don't want to be underweight. And that is that the NASPAS discount remains at elevated levels. So the NASPAS's see-through value in 10 cent is at an incredible 155% of its current market value. That is just unsustainably too high. And there are a couple of things that are being done by management in an effort to try and reduce that discount. And in fact, just this morning, one of the things that we have been expecting management to do was announced on Sense this morning. And that is a focus to try and reduce its holding process down to closer to 50%. And as a result of that, their weight in the JSE will drop from the 25% to a lower number. And the announcement this morning was actually, in fact, just that. That is just one step in this road that management are focused on in trying to reduce the discount. So for those four reasons, at the moment, we are very comfortable being at a point where we are not underweight NASPAS in the index. And then I'm going to move on to Kobus now. He's going to chat a little bit about the PGM space. And perhaps if we've got time, we'll come back and talk a little bit about NTN.
Well, thank you, Fred. Yeah, I guess linking on to maybe our process and more importantly, the philosophy of investing in equities. We'll talk about the platinum group metal sector as well. And although it's a cyclical sector, as it is like any other commodity which is dependent on supply and demand for its price, and that can vary greatly over time in terms of the market dynamics. That, you know, our analysis showed that this specific sub-segment in the broader material sector do offer a lot of those qualities in terms of demand and supply, which I'll take you through, and then also provide stability to grow earnings quite dramatically for the producers, and specifically because of the very strong operating leverage that these companies are benefiting from. So firstly, average global platinum group metal autocat loadings has been going up, and in line with the focus on a greener world and certainly the focus on managing emission standards has been a great help for demand on a lot of these from a lot of these countries. And you can see on the between the different countries here, especially Europe, North America, China, India, all of those has seen quite a ramp up in the emission standards. That is obviously in legislation that auto manufacturers got to comply with. An estimate here from Johnson Matthey and Anglo Platinum has indicated that just purely by the increase in the intensity of usage, so i.e. the higher grams of PGM metal put into an autocat, just purely from that, would see the demand grow by 15% from 2018 to 2025. And that has really absorbed a lot of the pressure we have seen on the numbers of global vehicles sold. And it just kept the demand story on the front foot, which was certainly a great help for us. And this was one angle, obviously, from a demand perspective that we did fundamental work on and appreciated at that point. Then secondly, from a supply perspective, it is very concentrated. Supply, platinum and rhodium are probably, between 80 and 90% of global supply. So it is a very, very concentrated a supply base. That's the first important point. In South Africa, you can see on the chart on the left-hand side, really, the production that's coming out of South Africa relative to some of the other countries. The second point is that there is an extremely long lead time. Once you started or made a decision to invest and expand or grow your production, till the point you can actually go and sell your metal into the market. And as an example, the K4 project is an old Lonmin platinum shaft, which was bought out by Sibanye-Stillwater. And this gives you indication, and this is a shaft that's been already started to be developed in the hands of Lonmin back in the years. And even though as a brownfield project, this will take, you can see the years, they're almost a 10-year period effectively until they can actually ramp up to full production capacity. So you're really dealing, and sorry, when you look at greenfields, when the likes of Impala and some of these other companies sink new shafts, I mean, those have been, approaching 10, 12, 13, 14 years until they actually ramped up. So, the problem for the market, but it's also a benefit for the producers, is that, if the market is effectively short metal and prices are very high and returns are very high, that they can't quickly just turn on like a light switch, the button to produce more platinum in the next month, in the next couple of months, in the next year necessarily, to that extent. So it's very hard for producers to respond to this demand environment that's been extremely robust. And that has really led to depleting stock positions. And specifically in the case of palladium on the following slide, that we've seen that palladium stocks has been in rapid decline from about 2015 this year, as the industry started to almost use and take these metal bars, etc., that's been stored in vaults, etc., and been introducing them more into the industrial use side, because the primary supply side could not really satisfy the demand expected, or the actual demand in the market, and hence why they had to start to use some of the stock. And that's also led to a lot of the stock positions contract to a great extent, as you can see in the case of palladium in this case. And then lastly, when you look at the market balance, certainly for these two metals, the platinum and the rhodium, from these two perspectives, on a forward-looking basis, that these markets are projected into a deficit environment and into an increasing deficit towards 2025. And this really speaks to the underlying fundamentals of this market, to say that primary demand, and especially when you look at it from all three metals, when you put platinum, palladium, rhodium, the three big PGM or precious group metal components into the mix, then as a whole, the market is moving into larger and larger deficits, or expected to move into larger and larger deficits. And the expectation from that is that will be supportive for prices, as I mentioned, in the inability for the producers to respond and produce more in a short period of time. And that really speaks towards, I think, maybe a sub-segment which we think has some of these qualities that really support earnings growth, and the duration of this premium earnings growth further out. And hence we have taken and have been in a relatively high position towards this precious group metal companies for some time, and the funds has enjoyed the benefit of that.
Thanks, Cuffe and Fred. Always amazes me the amount of detail and I guess just how well you end up understanding and appreciating these companies. Thanks for sharing that with us. And well done on the timing too, exactly to point, which leaves us with some time for Q&A from our audience. And everyone's done a really good job of sending through questions. So I'm going to pick out a few, and if we don't get through them today, then I will certainly do my best to come back to you with answers, and we'll collate something from the team and send that through to you. But I'm going to sneak my own question in first, because Fred, you did mention MTN, and I think it's such a fascinating share. I've watched it for so long, and on paper, it's such a success story. I mean, traveling through Africa, it's like the next Coca-Cola. There isn't a spaza shop or a small cafe in the middle of nowhere that doesn't have an MTN board outside. So their reach seems to be phenomenal, but that share price just hasn't, until recently, really lived up to expectations. Perhaps you can talk us through. I see that recently the team has upweighted their position in MTN. Maybe just a little bit around your thinking and the motivation for that.
Yeah, certainly. Thanks, Trace. In fact, you talk about the success story, but if you actually have a look at the numbers, it hasn't really been such a success over the course of the last few years. Taking a step back, 2014 was a year that we saw peak earnings. Between 2014 and 2018, the subscribers were up 5%, revenue was down 10%, profits were down 65%, and share price was down 60%. Since then, I guess if you look at the last 2 years, where it's become more on our radar screen, subscribers have grown 20%, revenues up 35%, and profits are up 60%. Now, it really talks to the evolution of a company, and it's not often in our space. In the quality growth framework, you get the ability to buy a company at a cheap valuations, because typically good quality growth companies are expensive. And 18 months ago, we saw the story evolving for MTN, where operationally, they had spent a lot of time focusing on improving the company internally. And to give you an example, over the course of the last 3 years, 3 years ago, they were the leading network in only 3 of their 21 operations. Last year, they were the leading network in 15 of their operations across the continent, including South Africa. I mean, we remember a few years ago where MTN was such a poor quality network in South Africa. Everyone who had an MTN cell phone was moaning about dropped calls and poor data quality. They are now the best network in South Africa. And these things don't happen overnight. It's a continual focus. And over and above that, returns have improved from 10% ROE, closing in on 20%. And so for all of those reasons, when we saw the share price collapse last year, when the oil price fell from $60 down to $10, the share price fell to 29 Rand. So through the course of that last year, we increasingly bought more and more MTN, and now it's one of our larger overweight positions. And we still think that with the asset realization program that's happening at the moment, that's going to carry on de-risking the balance sheet, and with a massive opportunity in the fintech space, there is still significant upside at the share price. And on a forward PE multiple of 10 times, it's by far from done yet in terms of the share price movement. So we're very, very happy with where we are at the moment with MTN and the way the management team is driving this company operationally forward.
Fantastic. Hopefully we'll see it live up to expectations then. Kobus, another really good question from the audience is, we see talk of a third wave and how you see that playing out. What does that mean for portfolio positioning, asset classes, etc.? As I said in the beginning, you saw that massive reaction to the first wave, but markets seem to have shrugged off the second. So I guess what next?
Yeah. Obviously, it's a concern, and I think especially given the variance that sort of has shown up as being a keen concern, and then secondly to that, also many countries has been very slow, including ourselves, maybe with the vaccination rollout and the programs as they've done that. But I think it is interesting, to note that, and when you look back into the second wave and you compare it to the first wave, and it's not just in South Africa, but in other countries like Europe and some of the other countries, that it almost seems like that the system has been able to deal better with the spike in infections. from various reasons, but certainly we've maybe in the second wave, we've certainly seen the impact actually being lower than many has feared. And you know, many expected the third wave in South Africa to kind of show up after the Easter holidays as it played through, and now more recently in specific areas, numbers has started to push up, and this will really be an important week or next 7 days to watch to see how those numbers roll out from that perspective. But you know, the expectation is not that if such a third wave would show its ugly face, that the real impact would be as severe, and the lockdown restrictions would be as constraining as we've seen maybe during the first and even in the second phase. So you know, to answer your question really is, I think, you know, not just ourselves, but many other countries have been able, and it looks like the system being able to deal better with this environment, and may not be as disruptive maybe as certainly the first wave was.
Yeah, let's hope not. Fred, another good question around NASPers and sort of change in regulation. I mean, you're always reading scary headlines about Chinese regulation. Is that something that concerns you, or something you factor in when you look at this future trajectory of the stock?
Yes, I mean, that's always the biggest unknown from a Chinese perspective, is how government views Tencent and the big tech companies. The tech companies have been the darling of government for some time now, and I guess over the course of the last year, well, 2 years ago, when we had those gaming regulations being introduced, and gaming approvals were halted, it was a process. And when we speak to Tencent quite a lot about this, in terms of their views on regulation and increased regulation. And their comment about regulation is that things only start getting regulated in China when they become big. So small companies can evolve and do what they like until they are seen to becoming too big, and then you get the regulation. So Tencent have always viewed the need for regulation in their space over time. So the evolution of regulation in this space is not a surprise. I guess what is a little bit unknown, and what's unknown going forward, is actually just how it evolves. But what we're very conscious about is Tencent appear to be on the front foot with regard to adopting and moving their business in the correct direction. So these things are not bad for large companies, and not bad for a company like Tencent to have regulation. What would be a problem is if the regulators start saying that you can't make money out of a certain product or a certain thing. And we're not seeing that currently. We're just seeing the regulators focusing on making sure that they are operating in a way that is not anti-competitive, for one instance. It's a way that they're not using customer data for the incorrect things. So this evolution and the change we're seeing in the government with regard to regulating in tech is a good thing. And ultimately, you go through these waves of regulatory being inputted, and companies need to adapt and evolve to work within that regulatory framework. So we see it as a normal course of action as an industry evolves at the moment.
It's not as scary as it sometimes may sound. I think we've got 1 more minute, and always a good question. I mean, I don't think we can do a balanced, focused webinar without discussing the currency. I mean, just incredibly strong at the moment. And I think questions coming through on the chat is our view around that, and maybe how that translates into offshore and onshore positioning of the portfolio.
Yeah, it has been, and especially from the point mid last year where the rand was traded over 19 rand against the dollar.
Yeah.
But when you really look back at the movement of the rand and many other emerging currencies relative to the so-called hard currencies, the dollar, the euro, the pound, etc., Aussie dollar, then there is a trend of depreciation over time, and you do see these very big diversions from that midpoint trend over time. And this time was no different to that, and we have seen the rand cutting back now closer to that midpoint level at current levels, just to maybe to position the current level of the rand. But certainly also, I think one's got to appreciate the positive developments that the country has enjoyed over the last couple of months, certainly from a political and economic perspective, and certainly from a government finance perspective. And all of those also plays favorably, I think, into a reading of the currency. And again, the real yield in South Africa is still extremely attractive relative to many other countries globally. And I think, when some of one or two of these factors start to change and moving in the right direction, even though it's just a delta change and it starts to move in the right direction, we have sometimes offshore investors that's really climb into our market and into our higher yielding risk assets. I think that's what we've seen. From our perspective and positioning side is in a balanced fund construct, is there's really great benefits to allocate money offshore and certainly at the right time, because the currency do provide a great diversification benefit for a portfolio, for a global balanced portfolio. And the reason is many times in a crisis, in a risk-off environment, when you are seeing risk assets, i.e. global equity assets and domestic currency selling off, then the rand appreciate and that absorb a bit of that volatility and a drawdown perhaps on the domestic side. So from a strategic perspective, we remain very much invested with our 30% global allocation, and a large part of that is allocated to attractive markets where we've been adding recently to the likes of, well, I say recently in the course of last year, into the likes of Europe and selectively into emerging markets.
Thanks, Kobus. I think that's all we've got time for today. I mean, I could talk for hours, but best we let you all get back to work. And as I said, we'll do our best to try and respond to your questions. But a copy of the webinar and the presentation will be emailed to you shortly in the next few days. And we look forward to seeing you all again. Thank you for joining us this morning. And thanks to Andrew, Fred, and Kobus. I love that. Very insightful. Thank you.